Given the recent sell-off in Asian equities, we see positive risk-reward emerging alongside more attractive valuations and have increased our asset allocation position to overweight. In China, we believe that the authorities have sufficient dry powder in their policy toolkit to offset the hit from trade by boosting domestic consumption. Over the last few months, we've seen from the Chinese the implementation of fiscal support, lowered reserve requirements and interest rates, and more can be done if needed. We are also constructive on the CNY at current levels and believe that the Chinese government is not incentivized to see excessive declines from here. With heightened near-term volatility, a temporary move across the 7.0 line in the sand against the US dollar should not be ruled out, but we see an eventual stabilization of the CNY being supportive of Asian equity markets. As a result of our upgrade of Asian equities, we are now overall overweight on equities. Given healthy economic and earnings growth, we believe there is scope to be constructive on equities even as interest rates rise. History shows that equity prices tend to appreciate when yields begin to rise from low levels. This is because the return of inflation to normal levels is a healthy consequence of growth and demand-side activity as the economy nears full employment and capacity. In the fixed income space, we are forecasting for the 10-year US Treasury yield to be at 3.4% in 12 months, and we continue to be cautious of duration risk. We favor emerging market high-yield bonds and see the combination of attractive valuations, healthy bottom-up fundamentals, and adequate economic growth outweighing EM headwinds over the longer term. EM corporate balance sheets have generally improved over the last few quarters, with default rates still expected to be below historical averages. While a strong US dollar could remain as a headwind over the near to mid-term, particularly with unabated trade tensions, current account positions across the EM universe have generally strengthened since the taper tantrum in 2013, and currency valuations are also broadly in line with their fundamentals.